The debt ceiling is the maximum amount of money that the United States can borrow by issuing bonds. It was created in 1917 to make the federal government more fiscally responsible, but it has been raised or suspended several times over the years to avoid a default on the national debt. The current debt ceiling is $31.381 trillion, which was set by Congress in December 2021. The debt ceiling matters because if it is not raised or suspended by Congress, the Treasury Department will run out of money to pay its bills and obligations, such as interest payments to bondholders, Social Security benefits, military salaries, and tax refunds. This would result in a federal debt default, which could have severe consequences for the U.S. economy and the global markets. A federal debt default could cause a loss of confidence in the U.S. government's ability to repay its debt, leading to higher borrowing costs, lower credit ratings, and reduced demand for U.S. Treasury bonds. This could also trigger a financial crisis, as many banks and investors rely on Treasury bonds as a safe and liquid asset. A default could also disrupt the payment system, as many transactions depend on Treasury bonds as collateral or settlement. A federal debt default could also have negative spillover effects on the global economy, as many countries and institutions hold U.S. Treasury bonds as part of their foreign exchange reserves or investment portfolios. A default could cause a loss of value and liquidity for these holders, as well as create uncertainty and volatility in the global financial markets. A default could also damage the reputation and influence of the U.S. as a global leader and partner. Therefore, it is important for Congress to act swiftly and responsibly to raise or suspend the debt ceiling before the Treasury Department runs out of money. Failure to do so could put the U.S. economy and the global markets at risk of a catastrophic debt crisis. Stock futures are contracts that allow investors to buy or sell a certain number of shares of a stock at a specified price and time in the future. For example, if you buy a stock future for Apple at $150 per share for June 1st, you are agreeing to buy 100 shares of Apple for $15,000 on that date, regardless of the actual market price. Stock futures are traded on exchanges such as the Chicago Mercantile Exchange, CME, and the Nasdaq Futures Exchange, NFX. Stock futures can help investors hedge against the risk of a debt ceiling crisis, which is a situation where the federal government reaches its legal borrowing limit and cannot pay its bills in full and on time. A debt ceiling crisis could have severe consequences for the economy and the financial markets, such as higher interest rates, lower credit ratings, reduced consumer spending and business investment, and a possible default on the national debt. One way that stock futures can help investors hedge against this risk is by allowing them to lock in a price for their stocks in advance, and avoid the volatility and uncertainty that may arise from a debt ceiling standoff. For example, if you own shares of Microsoft and you are worried that its stock price may drop due to a debt ceiling crisis, you can sell a stock future for Microsoft at a higher price than the current market price, and guarantee yourself a profit regardless of what happens. Alternatively, if you want to buy shares of Amazon but you are concerned that its stock price may rise due to increased demand for online shopping during a debt ceiling crisis, you can buy a stock future for Amazon at a lower price than the current market price, and secure yourself a discount regardless of what happens. Another way that stock futures can help investors hedge against this risk is by allowing them to speculate on the direction of the market or individual stocks based on their expectations of how the debt ceiling issue will be resolved. For example, if you think that Congress will reach a deal to raise the debt ceiling before the deadline and avoid a default, you can buy stock futures for the S&P 500 index or other stocks that may benefit from a relief rally. Conversely, if you think that Congress will fail to raise the debt ceiling and trigger a default, you can sell stock futures for the S&P 500 index or other stocks that may suffer from a market crash. However, stock futures also involve some risks and challenges for investors who use them to hedge or speculate on the debt ceiling crisis. For one thing, stock futures are leveraged instruments, which means that investors only need to put up a small fraction of the contract value as margin or collateral. This magnifies their potential gains or losses from price movements. For another thing, stock futures are subject to expiration dates and settlement procedures, which means that investors may have to roll over their contracts to maintain their positions or deliver or receive the underlying shares at maturity. This may incur additional costs or complications for investors. Therefore, stock futures are not suitable for everyone and require careful analysis and risk management. Investors who use stock futures to hedge or speculate on the debt ceiling crisis should be aware of the factors that affect their prices, such as supply and demand, interest rates, dividends, corporate actions, and market sentiment. They should also monitor the developments and negotiations around the debt ceiling issue closely and be prepared to adjust their strategies accordingly. Trading stock futures in a volatile and uncertain environment can be challenging, but also rewarding if you know some strategies and tips to navigate the market. In this section, we will cover some of the best practices for trading stock futures when the market is unpredictable and risky. One of the most important things to do when trading stock futures is to have a clear trading plan. A trading plan should include your entry and exit points, your risk-reward ratio, your position size, and your stop-loss and take-profit levels. Having a trading plan can help you avoid emotional decisions and stick to your strategy. Another tip for trading stock futures is to diversify your portfolio. Diversification means spreading your risk across different markets, sectors, and instruments. For example, you can trade futures on stock indexes, commodities, currencies, interest rates, and more. Diversifying your portfolio can help you reduce your exposure to any single market or event. A third tip for trading stock futures is to use technical analysis and indicators. Technical analysis is the study of price patterns and trends on charts. Indicators are mathematical tools that help you identify signals and opportunities in the market. For example, you can use moving averages, trend lines, support and resistance levels, oscillators, and more. Technical analysis and indicators can help you find entry and exit points, determine the direction and strength of the trend, and gauge the market sentiment. A fourth tip for trading stock futures is to manage your risk and leverage wisely. Risk management is the process of controlling your potential losses and protecting your capital. Leverage is the use of borrowed funds to increase your trading power and returns. For example, if you have $10,000 in your account and use 10:1 leverage, you can trade up to $100,000 worth of futures contracts. However, leverage also magnifies your losses if the market moves against you. Therefore, you should always use leverage with caution and never risk more than you can afford to lose. A fifth tip for trading stock futures is to keep yourself informed and updated on the market conditions and events. The market can change quickly and unexpectedly due to various factors such as news, earnings reports, economic data, political developments, natural disasters, and more. Therefore, you should always monitor the market closely and be ready to adjust your strategy accordingly. These are some of the strategies and tips for trading stock futures in a volatile and uncertain environment. By following these guidelines, you can improve your chances of success and profitability in the futures market.